Hi, Ray. Listen to your show on 1410 a.m. when traveling to and from appointments and meetings. I'm 59 and have 100% of my IRAs and 401ks in a total market and S&P index funds. I'd like to move 30% of my balances to a Ginnie Mae or a bond index fund. My question is timing. Due to low interest rates, the NAV for these funds are very expensive. Should I wait for the acquisition price to come down or move now, and why? Thanks, and love the show. Well, Phil, we love your show too, but Phil, how long have you been listening to me? How long has this been going on? How long? That was a song, by the way. Thanks, John.
You telling me? I know that's a song. Did you know Ace sang it?
I did know Ace sang.
Did you know
yes.
It's cart number 7? Oh, you wouldn't know that.
Listen, Phil, if you've been watching this show or listening to this show for a number of years, you know I'm not a 60-40 mix asset allocation kind of guy because, frankly, it doesn't work. It doesn't work. Go back to 2008. Everything went down except one asset class. No. What I am is a bucketeer. And what you need to do is a bucketization. First off, you have an S&P index fund and a total stock market index fund. What? Why would you do that? They both buy the same stuff. You've got overlap like crazy. Okay, you got a tiny bit of small cap in the total market index, but that's not an allocation. And then you want to go jump from the frying pan into the fire and buy a bunch of bonds in a bond index fund where the maturities are probably out 6, 7, 8, 9 years. And yes, your duration's probably 5, 6, 7 years, meaning you'll lose 7% for every 1% increase in interest rates. So I'm glad you're at least asking that question. No. You need to bucketize your portfolio. If you're retired, I don't know, did he say he was retiring right now? I can't tell. He's 59. Yeah, so you're on the cusp of retirement. So you know what to do. You take some of your money and you either purchase an annuity that gives you a guaranteed payment for the rest of your life if you're concerned about outliving your income for you and your spouse. Or if you're not too hip on the annuity jibe, that's okay. You invest some money in income-producing assets. Oh, you should tune into my Web Extra today because real estate happens to be one of those that can produce pensionized, annuitized pseudo income for you with yields of 5, 6, 7% perhaps. And then you take a bucket of super safe money, and for the next X number of years, you spend principal. He's spending principal again. That's wrong. If you've been to my workshops, you've seen me pull out the Journal of Financial Planning, Sandeep Singh, CFA, PhD, John Spitzer, PhD from New York University. They go into their finance lab and they look at every which way you can extract money from your portfolio. Yeah, they looked at a 60-40 mix of stocks and bonds and all that stuff, and then rebalance the portfolio with an asset allocation model, the thing that just about everybody else does. And here is what they determined, for those that haven't been to my workshops. We'll do this on a Web Extra someday too. They determined that the rebalancing method, that is the so-called pie chart, with a systematic withdrawal and then rebalancing of the portfolio, they determined that that was the worst thing you could do and left the least amount of money in the pot at the end of 30 years. And you know what they said was the best thing you could do? They said, if you bucketized. Of course, they didn't use the bucketization vernacular, all right? Because I invented that. But they said if you spent your bonds first and allowed your stocks the time they need to grow, that over that lengthy time period of retirement, call it 30 years, you had more money in the bank by spending the bonds first. Is that not a super oversimplified version of my bucket strategy? Yes, it is. Ray to Phil, it is. So as much as I appreciate all of this baloney of 60-40 mixes and asset allocations, and that's all fine and dandy if you're 35 years old and reinvesting all your dividends and contributing every single month during the accumulation phase, not that big of a deal. You're 59, Phil. You're 59. You're getting close to retirement, pal. And so therefore, you need to have an income bucket, something that produces safe and stable income. My preference, something that's guaranteed for life, or something that's very stable that you can get a good long-term income stream from without a ton of volatility. And then you need to have some safe money and some risky money. The risky money, that's called stocks. And if you want to do an S&P or an index fund, be my guest. I wouldn't because I'm not too fancy on buying the most expensive stocks because they're market capitalization weighted. An index fund, by its very nature, is market cap weighted. And I know they beat 80% of the money managers out there. I get that. But they don't beat the other 20%. And by the way, I'm not so concerned about return. Johnny, we've talked about this before too. I'm more concerned about what is the risk-adjusted rate of return. We're going to talk about real estate in a few minutes in the Web Extra. And I'm going to throw up a chart. I'm not going to throw up, but I'm going to show you. Okay. I'm going to show you a chart. We'll pull up a REIT ETF. And I've just been bragging about how great real estate is. I will show you a traded REIT stock ETF. And I will show you a 76% decline, peak to trough. And then I will ask this question. How many of you that bought a stock that went down 76% hung in there for the 200% rebound? Nah, come on. Because if you're telling me you wouldn't have sold, you're either a long-term listener of this show. Because you'd say, if you're a long-term listener to this show, you'd say, ouch, I hate the fact that I lost 76%. But I love the fact that I'm getting a dividend and I get to buy all those shares when the price is so low. But most people didn't do that. Most people turned tailed and ran and sold out at the bottom. So I need to have my equity portfolio because, hey, just like real estate investment trust could go down 76% like they did, your small cap portfolio could do that. Your international portfolio, hey, listen, the S&P 500 went down 60% in 2008. But were any of my bucketeers concerned about that? Nope. I'll tell you why. They had a 401k plan. They were still funding their 401k and buying all those shares dirt cheap. And all the dividends from their dividend-paying stocks were being reinvested, not spent. That's mistake number, 18 in my list of retirement planning mistakes. Spending dividends from a volatile portfolio. No. Reinvesting dividends in a volatile portfolio. Therefore, buying more shares as that volatility causes the prices to come down. That's smart. And how do you do that? You have a safe bucket of money that you can drain when you need income. Man, I've written 3 3/4 books on this subject, and I think I just did the whole bucket strategy right here on the air. Make sure you keep a tape of this one, John.
I'm rolling right now. Can you
All
say
right.
it all again? I may have missed the first 7 or 8 minutes.